Good day, everyone, and welcome to yet another episode of Analysts, Insights, where we talk everything business, finance, and investment. And I'm your host, Tabonga Njaya. Today, we're joined by our usual analysts, that is Rufaro and Ranga. Welcome, gentlemen.
Good afternoon.
Good afternoon, Taiwanga.
For today, we are going to look at a lot of topical issues, and among those, there's been an introduction of a recent statutory instrument by the government, that is the statutory instrument 127 of 2021. So, Ranga, can you just give us a brief overview of what's that to do with?
Thanks, Tawanga. I think I just want to look at the impact of any announcement on the market.
Yes.
So markets are very information sensitive. So information that flows onto the market can either have a positive impact on the prices on the market, or could have a negative impact, or sometimes it's muted. You don't see the market reacting to that. But specifically to the SI, I think when you just look at the overall objective and the area that's being targeted, which is to do with foreign currency management, it has been a very sensitive area on the market, in the sense that it's a market that is coming from an environment where activity has at some point been stopped, some directives coming that had an effect of halting the market or suspending it. So this one is coming on the back of that, and the fact that we were actually coming from a scenario where there's been some sort of stability in the currency market, which maybe market players were beginning to ask if it's going to be sustainable and if it's good for the market. So having an SI coming at a time when everyone is feeling that we are more stable, it's actually going to have some negative impact on the market, because right now one area that you have to look at is what's going to be the impact on the performance of the businesses that are listed on the stock market. So if you are a retail business or you are any consumer-facing business, you are faced with a scenario where you can't possibly there are some limitations, or it's actually unattractive for you to be collecting US dollars, given the some what you may have to do with that. And also you want to think about the whole currency issue. One thing that made this market very attractive in 2009 was the fact that it was trading in US dollars, which is a stable currency. And when an investor is coming into a market, they are looking to get a return, which is measured by the return in the local currency. But there's also an element of that return which is linked to the currency. So when you're getting into a market which has got which is transacting in US dollars, it has to create a level of confidence, because it means there are no foreign exchange risk on your part. So this one, maybe the impact is it's adding to the whole risk around the foreign currency issue. It also adding to the uncertainty, and it's not very clear what may have motivated it, given that we were coming from an environment of stability. And right now there's a lot of confusion and commotion on the marketplace, and I think there is need for some more clarity before market players would have some sort of a determination as to what will be the impact of everything on the markets.
There's something that you mentioned that, like when you started giving us review, that is that markets are sensitive, but we still want maybe the projected transmission mechanism that now that we are sort of like restricted or will be penalized for transacting in foreign currencies. So maybe vis-a-vis with the market, how is that going to affect the capital market? Maybe Rufaro, you can come into that.
So I think in the short term, it's probably bullish for the ZSE, because like OK, which is no longer accepting US dollars,
yes,
and a lot of businesses in the formal sector will not be accepting US dollars. So they are going to be their dollar floats are going to be significantly higher, and it may turn out that they may not be able to convert those holdings into inventory as quickly as they would like, and they might want to ring fence those holdings from inflation by placing them on the ZSE. So in the short term, as a lot of businesses in the formal sector grow their Zim dollar cash holdings in a way that they hadn't planned to, on the back of SI 127, we might see more of them come to the ZSE to ring fence that value from inflation. So I think in the shorter term, it's bullish. In the longer term, it's unclear because it's a function of what happens with inflation and money supply growth. If SI just changes the way we transact, but Treasury continues its disciplined approach to managing the national accounts and doesn't print, then it shouldn't have an impact one way or the other in the longer term. But in the short term, I think it might be bullish.
That's good to hear, but can we just maybe tone it down to, since we're saying that now there's been an influx of retail investors. Retail investors are our normal households, and we have mentioned that inflation is a function of perhaps one element that you left out, that is money demand. So now that we are forced, let's just say that we are restricted to trade in our local currency. How is that going to affect the local household? Now, vis-a-vis, yes, we have explained that it will transcend to a bullish outlook for the capital market, but inherently, we are saying, will we see an increase in the prices of the normal goods and services, perhaps? Ranka, you can say to that.
I think what you're going to see, obviously, is demand is going to take a beating, especially given that every demand that was being made by US dollar purchases is going to be for a brief period. It won't be there because right now it has become very expensive. Prices have actually gone up in US dollar terms, because retailers and all these merchants are trying to work backwards using the official rate or the auction rate of 84 to try and get back to the Zim dollar prices that they had in mind, and then converting that back. So what it means is prices have actually gone up by a factor of 35% in US dollar terms, to a point where it means since it makes it too expensive for you to be transacting in US dollars, and sort of forcing people to be using the local currency. But the problem is the merchants, the retailers, they still have to be importing the raw mat that they use, and also whatever product that they are selling in the shops. So it means they'll still have to resort to getting currency from other sources. Obviously, it was being partly funded by the auction, but the auction does not have capacity to cover the needs of industrialists and the people in commerce. So it means we're going to see, we are likely to see significant demand on the parallel market, because all these merchants who ordinarily would get, say, 30-40%, if not 50% of their sales in US dollars, they are probably going to get almost nothing. And for their foreign currency needs that are not met by the auction, they have to go to the parallel market rate. So this is not good for the stability of the exchange rate, and it's likely to reverse some of the stability and the gains that we have seen. And also just to comment briefly on what Faro was talking about, how this scenario is bullish to the market. It's bullish to the extent that the market will go up, but it doesn't mean it's positive news. You have to understand this market tends to be more a bad news market. So whenever something comes up that causes a hive of activity on the market, it tends to be a sign that something negative. People are just taking a defensive approach. Most of the money that is in US dollars is actually moving onto the market to try and hedge. But long term, it's not good for the market, because you are going to see activity that's not being driven by fundamentals. This is activity that's being driven by fear, worry about the currencies, and the same reason why we have seen a flight of capital from the market, because all the investors who came in when it was a proper US dollar environment. The moment we actually went back to the Zim dollars, they saw that as an added risk element to their investment, and most of them have been taking money. And this is happening at a time where a whole market has been created that should be trading in US dollars. That's the VFX, and we keep getting these changes. To the foreign currency management policies. It sort of confuses people and also confuses the investors as to what they will have to do.
Yeah, you have a point there, but still on the same note of regulations, perhaps in 1 minute, maybe we can just touch on the subsidies framework in general that the government has seemed to be introducing to curtail public expenditure. Maybe you can just comment on that, then we round up the segment.
Yeah, look, I think the auction is a significant subsidy, and to the extent that we have allocation of exporters' receipts made for items that are considered priority. And I think to some extent this makes sense. However, it creates a challenge for importers of items that are not considered a priority in terms of their capacity to actually bring in these goods and services. And this is why we have two markets, and the challenges associated with that have motivated the state to move in with this statutory instrument. So I'm a free market capitalist. I believe in free market capitalism, and so the subsidies are basically an intervention in the free market, and some of the outcomes when you have subsidies are unintended. There are second and third order effects of subsidies that are not necessarily desirable. So hopefully, Treasury is given to being to reading these outcomes and adapting to some of the negative outcomes, so that we don't have this huge arbitrage between the official rate and the power market rate.
Quite some interesting insights there. Please catch us right after this break. Welcome back. Moving on with our discussion. Rufaro, can you comment on the recent increase in the cost of living?
Yeah, sure. I think it's important to remember that we live in a country that is suffering from hyperinflation. So if you look at the latest annual inflation figure for May, that is available for May, for example, it's 161%. This is definitely in hyperinflation territory, and you would expect that there would be upward revisions the cost of living on a monthly basis, in an environment of that nature. I think what's positive, however, is the outlook. So the April inflation number was 194. It's still coming off. It's 161 is a significant improvement, and it looks like we are on a path to seeing lower inflation going forward. So if Treasury continues its disciplined fiscal policy, and we see constrained or slow growth in money supply, I think that inflation will come off significantly, and these big jumps in cost of living that we're seeing may become a thing of the past. So touch wood that the positive trend that we're seeing inflation continue.
Can I
Yes.
jump in there? I think the only worrying thing is that we have seen recent increases in prices, power tariffs, and also a general rise in prices across the board. So when you've got a scenario where power tariffs go up, they're a big, they play a big part in the entire expense matrix for most businesses. So chances are you start seeing businesses actually adjusting their prices also to try and take advantage or to try and cushion themselves from the impact of the power tariffs. And I think my other worry is the stability that we'd actually enjoyed maybe in the last 6-8 months. It's not coming on the back of maybe a structural shift in the economy. But you get a feeling that maybe there is an invisible hand that is trying to keep inflation at some level, but that's not sustainable. At some point, whatever is controlling that will have to give in to the pressure. And obviously, on certain areas, obviously on the food side, with a good crop expected, maybe that area the stability can be sustained there. But overall, and what we are seeing on the current side, the fact that we are a major importer of pretty much everything, it means once you start seeing some instability or some disturbances on the currency, and the fact that retailers will be maybe forced to start resorting to the power market to get their currency, since they are failing, they won't be able to collect much or maybe earning enough revenue in US dollars with these new changes. That might actually have an impact of stoking some inflationary pressures. So look, it remains very uncertain. It also depends on how it's actually made worse by the shopping and changing in the policy framework that we are seeing.
Thank you for that, and thank you for your valuable insights. But before we round up, can you just maybe give us a brief comment on other developments that have happened on the stock market, if there are any? We'll start with Faro and come on to Ranga, then we'll round up.
So I think on a positive note, we saw a significant growth in the number of units on the Old Mutual ETF that are listed. So that product is doing quite well, and the way it's structured is as it grows, it means that there's more activity and trading on our local base, which is something that all capital market players want to see, and hopefully they will inspire other players to list instruments that the market will find interesting and adopt.
Yeah, so for me, it's been the fact that volumes have actually been sustained at higher levels. So on one side, we are seeing foreigners that are selling because of their worry regarding the outlook of the economy and the prosperity of the country. But there has been an increase in local investors taking up the script that's being sold by these foreigners. So the impact of that is to leave the market in the balance. Obviously, a market of our size and also where we are in terms of economic development, we would need to have more foreign inflows as opposed to having these outflows. But at least we have got some activity that's taking place. What was needed, obviously, was to have some progress economically, and for these companies to start showing some numbers justifying some of the movement that we are seeing. But I was so looking forward to the Delta briefing until it was announced that it has been postponed. And usually Delta tends to give you some sort of a picture of how the entire economy is actually performing. And I think it was one briefing that I was looking forward to. And I think there's still a lot that we can learn from the performance of these companies in the last 12 months. But everything obviously has been thrown into turmoil by the SI. And I can just look at a scenario where if someone had done fairly well and they're looking to declare a dividend, now with these new changes, they might be saying, okay, maybe we may need to conserve some cash because we don't know what lies ahead of us. So yeah, the results are something that we are also looking forward to, and also the ETF just shows an increase in the take up by retail investors because it tends to be an attractive avenue for them, especially the type that used to be playing on the unit trust area.
Okay.
Yeah. So just to add to that, I think Delta is always a good one to analyze because it's a proxy. It's a good proxy for aggregate demand in the economy because their products are consumed by almost everybody at some level. So of course, they're going to report inflation-adjusted figures, which are quite difficult to wrap one's head around. But I think if we focus on their volumes in terms of hectoliters of beverages compared to prior periods, that will give us a very good sense for what's happening in the economy in the context of aggregate demand and how well the company is doing and what the trend is compared to last year when we had we spent significant periods under lockdown due to COVID. So I think that's one of the things that we will pay very close attention to and discuss some more in the next episode.
Thank you, gentlemen, for joining us and taking your time to share your views with us, as well as our viewers for staying tuned. Please use the details displayed to share your views in comments. Thank you.